Hey guys, Stockaholics, thank you guys for being here today. I wanted to talk a little bit about investing abroad in this video. Uh, I look for opportunities all over the world. I make videos talking about companies that I find interesting in different parts of the world. I also consume a lot of content from some other YouTube creators, people who write articles from all over the world too. And I think that we live in such a connected and increasingly globalized world that I think that if you focus only on your own country, you're missing, potentially missing a lot of tremendous opportunity that exists out there. I also wanted to talk about what I think a lot of people perceive the biggest risk for foreign investing, and I wanted to talk a little bit about currency risk and why I don't really care about that. The reason I wanted to talk about that, I had an interesting comment on my last video where I decided to think a little bit more about that, where the individual seemed like they were concerned about the currency risk for investing in Gazprom, which was one of my foreign investments I've been talking a lot about recently. So I kind of wanted to address why I think that's kind of faulty logic. I don't think that makes a lot of sense to care too much about currency risk. All right, I wanted to share 3 reasons why I invest abroad. And the reason number 1 is very simple: because I can, and because opportunity exists everywhere. There's all kinds of opportunities, and they don't only exist where I live in the United States, right? But like I mentioned, we live in an increasingly connected world, and part of that is due to technology. And what this technology allows us to do is to become connected to, at least through financial means, through different companies in the world. The OTC markets and the exchanges have really simplified and really made foreign investing wherever you are in the world a lot more accessible than it was in the past. You know, if I lived 20 years ago, if I was interested in investing as an American in China or Australia or Africa or wherever, what I would have to do is I would kind of have to get on a plane. I would have to to wire some money to wherever I want. I have to open an account somewhere else, and then I'd have to kind of directly invest on that exchange, wherever that may be. That doesn't exist anymore. There are brokers out there that literally connect you to wherever you want to invest. So if you don't use these kinds of opportunities, you're really missing out. Okay, and reason number 2 is that some countries, they just do some things better than some other countries. So I'll kind of give you guys some examples to kind of demonstrate what I'm talking about. So let's take a look at one of the investments I've been talking about recently, which is Gazprom. They have a geopolitical advantage because in the oil industry, because they have, first of all, they have tremendous resources. They can drill them very economically compared to some of their competitors, and they're located in a position in the world that some of their customers their biggest customers are very close by, which means the transport costs to deliver that commodity are very small compared to some of their competitors, right? So this gives Russian oil companies an advantage over what a lot of their other competitors could in other parts of the world, right? Now, if you look at a country like Australia, one of the things that Australia does very well is they have different commodities too. They have, I think, iron ore, right, that they can extract very tremendous amounts at very competitive rates too. One of the things in New Zealand, by the way, there's a milk company that I do there. If you think about the population for New Zealand, it's a very small country, but relative to their population, they have an incredibly large and successful dairy industry, which is why I invest in one of the reasons, not the only reason, one of the reasons I'm invested in A2 milk in that country. If you look at Africa, one of the advantages of Africa if you don't know what that is that they have tremendous growth. Their GDPs are, in many of the countries in Africa, are growing, in some cases double digit per annum levels in that country. So if you could find an interesting and successful company in Africa, the chance that that's going to be have tremendous compounding returns is incredible. South America, again, so they have some of the most the highest quantities of copper. They can mine it at, because of the high grades of copper in that part of the world. They can invest it at, or sorry, they can mine it at very competitive rates. Now, I also invest in my own country too. I invest in the United States. People might get offended by this comment, but I'm going to say it anyway. The United States is fucking awesome at technology. We are one of the best in terms of large cap technology names in the world. We are some of the most innovative people in the world. And we also have some of the best healthcare and medical advancements in technology too. And I think a lot of the reason for that is either that we developed that here, or because we can attract all kinds of immigrants around the world who can improve our innovate as in our own country, right? So some countries around the world, they have distinct advantages in the certain things that they do. And that's the second reason on why I want to invest all around the world, to take advantage of those things that some countries do best. All right, reason number 3 is diversification, right? If I have all of my eggs in one basket, or if I have all of my eggs in one country, the chance that something bad happens in that part of the world is very likely. So if I crack a few eggs, something goes wrong there, that's okay, because my basket of my investments in different parts of the world, well, the rest of those should mostly be okay. A lot of people might think that the United States doesn't really carry any risk. I don't really share that view. I think that all places carry risk. One of my favorite scientists, deceased, it was former scientist named Stephen Hawking. And one of the things that he also mentioned that kind of gives me, I guess, a little perspective on this, is that he thinks that we need to diversify away from one planet, because if we have all of our eggs in one planet, then the chance that human civilization ceases to exist at a certain point is increasingly likely. So maybe I'm getting a little sidetracked here. So when I think, the reason I say that is because one of the things that you could imagine would be the most successful, most diverse thing would be human civilization. But when somebody as smart as Stephen Hawking says that you should, we as a species need to be more diversified, that gives me some perspective as an American. And a lot of Americans think that their market is untouchable. It is one of the best in the world. And to some extent it is, but that doesn't mean that it is without risk and without flaw. So I want to invest in as many, not as many, but as different areas in the world that are good investments. All right, one of the biggest risks that I interpret that a lot of people seem to have for investing abroad is this concept, and it's currency fluctuations. So often the biggest perceived risk is from these things, right? I wanted to talk a little bit about this risk and why I don't really think it's as big a deal as many people think. So currency exchange risk, first of all, if you guys don't know what that is that foreign companies often generate sales and income in their local currency, such as euros or Swiss francs, right? As a result, investors from the United States must convert these currencies into US dollars at some point. So I'm an American, and if I want to buy a company like Gazprom, I am buying a company that is denominated in rubles, right? So if the dollar depreciates and the ruble appreciates, my investment in that foreign country could likely have some risk because of that, right? Those exchange rate problems, right? So unfortunately, the exchange rate between currencies fluctuate over time, and this can lead to unexpected gains or losses. All right, so I'll give you guys an example of currency risk. So like I mentioned, I'm an American. One of the companies I own is in Russia. So let's say that Stockaholics, that I bought 100 shares of Gazprom at an average price of $5 US. So if I was to purchase those shares at $5 US, this at current exchange rates would be equal to about 36,431 Russian rubles. A few years, let's say that I hold those for a few years, and let's say that a few years from now that I sell those 100 shares of Gazprom, and again, these might be that investment might be denominated in rubles, right? Let's say that I sold that investment for 100,000 rubles. So that would be a I don't know, a 2.5 times gain compared to the time that I purchased it, right? But let's assume that the ruble appreciates compared to the dollar about 50%. So it was a disaster in terms of currency, right? So although the stock price appreciates almost 3 times, the total sale in US dollars, the total gain was only $186 profit. So in this scenario, I lost a lot of money to this example of currency risk. Now, the thing to think about is it's not many people can can accurately forecast these kinds of currency fluctuations, right? And the thing about it is too, if you look at the ruble to the dollar, for the most part, the ruble has been consistently depreciated compared to the dollar. So the chance that the opposite happens is probably more likely than this scenario. But either way, when I invest in abroad, I would assume that it's 50-50. When I'm investing in, I don't think much about this. I think that if I'm investing in enough countries, all of the risks from holding all of these different companies denominated in different currencies is likely to, in the long run at least, to kind of level each other out. All right, something that I've learned very recently is that even though you're investing on the OTC exchange, and even though you're buying securities and selling securities that are denominated in your local currency, this is kind of an illusion. It doesn't really matter because you're still purchasing companies that their business is denominated in that local currency wherever that may be. So to kind of show you an example of that, this is that company again that I was talking about, Gazprom, right? This blue line down here is Gazprom, but it's the OGZPY listing on the OTC market exchange. This is the listing for Gazprom, but it's denominated in dollars, US dollars. Now, if we compare that to GAZP, that is the listing for Gazprom on the Moscow exchange. It might appear that, well, why is there a big difference? Gazprom on the Moscow exchange is far exceeding the growth that you would see on the OTC market. And the reason you can explain that is through currencies. So over the last decade, what you notice with the dollar compared to the ruble is that the dollar has appreciated where the ruble has been declining. So since about 2009, the US dollar compared to the ruble has appreciated 180%. Now, this doesn't mean that the dollar has appreciated, far from it. The dollar has been declining over time compared to all assets around the world, and the same with the ruble. But if you just compare those two things, ruble has been depreciating much faster compared to the dollar, right? So if you compare the gap between these two listings, that is how you can explain that gap. It is through the appreciation of the dollar when compared to the ruble. So really, even though this might appear like this has been a mostly flat growth in the company, it's actually been declining because if you bought shares in Gazprom, I don't know, let's say for 100 rubles in 2009, and they're worth 100 rubles today, rubles are worth a lot less than they were 10 years ago, right? And the same is true for, the when purchasing it in dollars. So the gains that you're making on this company are really the same, right? Okay, so why don't I care so much about currency risk? Okay, first, currency risk is unpredictable. So I'm not that smart. Maybe there's some successful forex traders out there who might want to dabble in these kinds of currency risks and take those to their own advantage. I don't. I'm interested in investing in companies. I'm interested in investing in assets, right? Businesses. Okay, and in the long run, these currency fluctuations, these currency risks, they're going to have minimal impact on your portfolio, either negatively or positively. And again, I think that's one of the things a lot of people forget, is that these currency fluctuations can affect your portfolio positively too, right? As long as you're investing in good companies at reasonable valuations, in the long run, you're going to make money. The more countries you invest in too, the more this risk becomes neutral. So let's say that I hold 10 companies in 10 different countries. Let's say 5 of those countries, their currency appreciates compared to mine, and 5 of those countries, their currency depreciates compared to mine. Overall, the net result from all of those currencies, ebbs and flows, is going to be neutral with each other, right? So the more countries you invest in, the more this risk becomes neutral, and is because of those ebbs and flows, right? Now, more importantly, when you're thinking about this currency risk, I think currency itself is a risk, right? The point of investing in stocks is, number one, to invest in assets, right? And assets, if I buy a business, or I buy gold, or I buy silver, in a year from now, some of those assets, gold and silver, will be the same. They're going to stay the same. A business, some businesses will stay the same. Maybe they won't grow. But some assets, the point of investing in stocks in particular, is because those assets can grow over time. Those can be compounding growth. They can become compounding investments, right? So the point of investing in stocks is to hold an asset that is likely to grow and compound in itself, intrinsically, right? Assets today are the same as assets tomorrow, but tomorrow a currency will most likely be worth less than it is today. All fiat currencies historically have ended at zero, but assets never do. All right, to kind of demonstrate how this currency risk doesn't really matter, I kind of wanted to give you a worst case scenario, and this is an example where the currency of a country that you're investing from is appreciating compared to the country you could hypothetically be investing to. So this is a worst case scenario to look at a great possible investment that got absolutely wrecked by currency risk. So this is the US dollar Swiss franc exchange rate. This is a historical chart. So what we're looking at here is the Swiss franc compared to this is the US dollar compared to the Swiss franc. So the US dollar at some point, kind of the opposite of the ruble, was worth more at a certain point, but the Swiss franc appreciated in value. In fact, the Swiss franc was one of those currencies that went through some kind of like a deflationary kind of scenario where it became more valuable compared to other currencies in the world. So the Swiss franc has appreciated against all currencies over the past 30 years. Okay, so let's come up with a hypothetical scenario where we're investing with a currency that is actually deflationary, which, by the way, is probably impossible to predict successfully, repeatably for 99.99999% of all people out there, right? So, but let's come up with the hypothetical scenario anyway, where we have this currency and we've decided to come up with a successful investment in the outside world. So if a Swiss investor decided to invest in the United States, so let's say in about 2000, we're in that the bubble, right? The dot-com bubble. The United States is looking very, very attractive at the time. And let's say that you see all these emerging technologies. And by the way, that's one of the things I mentioned. The technology in the United States is one of the things the United States does very well. Let's say you notice that in Switzerland, right? And you're saying, oh, maybe I want to, maybe, the Swiss market is pretty good, but maybe instead I should invest in the United States. Maybe I want to take advantage of the growth that I'm seeing in the United States, right? So let's say you invested with your Swiss francs, and instead of we'll just come up. Well, first we'll say that you invested in the Swiss market. So let's say that Swiss investor invested 1,000 francs in the 2000 dot-com peak, 2000 dot-com bubble, where also the currency, the currencies relative to the Swiss franc also peaked, right? Let's say that they invested 1,000 francs in the 2000 peak. So they invested somewhere around here, right? So if they had done that and they invested in some kind of a broad market index during that time, which many of those kind of tools that we see today probably didn't exist back then, but let's say that they did. And they invested 1,000 francs. The return that they would have on that today is a 43% gain, or they would have a net profit of 430 francs. Okay. Now instead, let's say that they recognize the growth that was taking place in the United States, like I mentioned, but instead of investing in the Swiss market index, they said, maybe I would like to instead invest in the growth we're seeing in the United States, and instead invest in the S&P 500 in the United States. So if that Swiss investor took those 1,000 francs in 2000 and they invested in the S&P 500, if they converted that to invest in, let's say, an ETF, which by the way probably didn't exist back then, and they invested $555 at the time. So if you converted the dollar to francs at that time, they would have had to convert it to $555 to invest in the S&P 500. Now today, that investment of $555 would be worth, with the appreciation we've seen in the US stock market, it'd be worth $1,565, right? So it was a 3x gain in the United States currency, but not relative to the Swiss franc, right? Now let's say that they then said, okay, this is the end point for me, I'm going to cash out. If they converted that back to francs, in a worst case scenario, right, they would have now have 1,407 francs. So the gain that we've seen with a depreciating currency, with only investing in that deflationary kind of market, the gains that you're seeing in that market relative to the S&P 500, and which is an inflationary market relative to the Swiss franc, is about the same, right? Now this isn't a worst case scenario, by the way. If you do this same example in any other instance besides the worst case scenario, if you had done this for example in 2008, the gains that you would have had in the United States relative to the gains you would have had in the Swiss market would probably be double, if not triple, right? This is a worst case scenario, right? So if you are, regardless of the currency fluctuations, if you're investing in successful investments in assets that are appreciating over time, these currency market forces are pretty irrelevant.